What is going on? We're back with another bootcamp video. This one is going to be going over volume. And volume is something that is definitely better than indicators. So this is better than indicators. It can be maybe better, maybe considered better than trend lines. Um, the thing is, every single thing, like a indicator is lagging. Um, Technically speaking, volume is lagging too, but not really. And I'll explain. So what volume is basically the number of transactions that occur within one candle. So if I'm on the 15-minute time frame and we go to a 15-minute candle, it's the number of transactions that occur during this candle. Okay. So if there's 50 people buying from 50 sellers, then that means there's 50 volume, because like 50, not 50 people, 50 contracts being bought and then 50 contracts being sold to those buyers, then there's 50 volume. Okay, and it just, if we go on the 5-minute time frame, it would be like it would be one of these things down here, one of these candles or these bars is just the volume of the transactions that occurred during that time period. So if we line up this candle with this, you can see right here, it actually doesn't show me a value under here, but let's say this is about 100. Let's say this is about 10,000 volume right here. So this is 10,000 volume, meaning there's 10,000 transactions that occurred during this candle. And volume can tell you a lot of cool things. So this isn't gonna. There's like if you type in on YouTube like how to use volume, there's a ton of like in-depth guides. Volume was actually one of the only books I ever read regarding trading was Volume Profile, or VPA, Volume Profile Analysis by Anna Coling. Now it wasn't a bad book, but again, it's gonna set you up to fail, I think. And here's my take. So we know that the market is traded algorithmically. And if you ever see like a big news event like FOMC, okay, we hit FOMC a few days ago. What you're gonna notice is if you ever see like a big candle during FOMC, oftentimes you can see the same volume for a big giant FOMC candle and see the same volume for like an opening candle that's just much smaller. And it just really shows that the market truly is algorithmic. And there's a lot of dark pool. There's a lot of dark pool volume. There's just volume that doesn't show up here, and there's just it's too. It's just not. It's not like what's the word? It's just not concrete enough. You can use volume to be successful, but you ideally want to use it with other things. Now, oftentimes you're going to see big spikes at around open because that's when the stock market opens. So at 9:30, you can clearly see there's a big spike of volume, right? And probably like, well, what does this mean? Half the time, it just shows that okay, there's a lot of buyers and sellers here. That's it. Now, one of the ways you can use volume is maybe for like low volume pullbacks. Okay, so if I just type in Google something on the internet, a low volume pullback, you're going to see a bunch of different diagrams on what this could be. So you can see right here, as price gets lower, you can see volume is getting lower. So if I go back to the chart and try to show this, see how right here, see how as price gets lower, or price goes down, the volume is also going down. Well, what happens? After the volume goes down, this is called a low volume pullback, we get a big spike in buyers again. And I'm laughing at, like, I laugh, and this is very hysterical to me because you're if you're thinking, well, how does that supposed to help? I don't even know. Okay, this is just something you should know. You should know what volume is just because there's a lot of different ways you can use it, but it's not like super helpful. It's not going to be as helpful as what I'm going to teach you later in this course. You do not need volume. Volume will not tell you much sometimes, and that's just the way it is. So this is just an example of a low volume pullback where price kind of goes down, so does volume, and then boom, straight up. And the volume raises up a little bit, but you can see like it's kind of silly because why was the volume so high here? Well, that was the open of the market. So how is that supposed to tell? Like, of course it's going to be high here and go down. Like that's a given. And it's kind of silly because volume is just hit or miss. I don't think it's useful. And if anyone wants to argue with me, feel free. I seriously don't think it's useful. Um, it'll tell you, like, again, this is going to tell you the volatility is going to be much higher, which it clearly is. We can tell by the candle. We don't need to see the volume to know that there's going to be a lot of volume in this candle. We don't need to see the volume to know there's going to be little volume in these candles because we're just chopping around inside the same exact range, right? It's just volume tells us a lot of things. We already can kind of tell by the candles. And I saw this tweet one time. It was basically, I don't know what the tweet said, but it said volume will go to good price action, meaning if we get good price action or come to a key level, the volume will come in. So as long as you know that key level or that key fair value gap wherever and you get in, the volume will come later. You don't need to see volume to get in the trade after. Now, of course, a big spike in volume might tell you something. It might tell you, okay, big spike in volume. I think that's going to be good volatility. I now know that's going to be good price action. So that may trigger your brain and be like, okay, we got a lot of volatility. And typically a lot of volatility in the market means we typically get good price action. So it might trigger your brain to be like, all right, we got a lot of volume. I'm going to try to enter a position or maybe wait for a pullback or something because we have a lot of volume. That means we have a lot of volatility. We have a lot of volatility. That means we're going to get clean price action. So that's like another thing. And other than that, I don't really use volume. There is an indicator called volume spikes. And this is actually very interesting. So there's an indicator called volume spikes. And it's basically an indicator that sometimes might tell you when we might reverse. And it's kind of cool. So you can kind of see this little dot here, meaning there's a volume spike here. And it doesn't actually show you it right here, so I'm not sure where it gets its calculations from because there's no spike here. But sometimes if we get a volume spike, it means it's more of a liquidity grab over like a actual reverse. So let's say there's no volume spike. Let's say there's none in here. That means we're not going to go way down. Okay. Now this one, we don't really go way down, but we do reverse somewhat. But this one right here, we do go way up. So again, as no indicators are 100%, it's just kind of a thing that it's like a volume spike, and typically a volume spike tells you when we might reverse. Another example would be right here. This is a really good example because there's a volume spike below a low. Now, if we think about stop loss orders and where people place their stop losses, all right, and remember, as I do this little bootcamp thing, you need to understand, you need to be looking at the market, and your brain should be wired to think, where do people have their stop losses? Now, people will probably have their stop losses below this low, below all these lows, in fact. And you can see it's a really nice kind of broadening, like a trend line that you bounce off of because every single time we go down, we stop out these guys, then reverse. So we're wrecking them. But you can see this would be a good example because if we have a green dot here for a volume spike, it maybe tells us that, okay, there's a ton of volume in here. And thinking from like a scientific point of view, why would there be a ton of volume there? Well, there would be a ton of volume there because there's a ton of people getting stopped out there, which means it's probably a good reversal point. So if this lines up with another strategy you have, maybe there's a VWAP, maybe there's an EMA here, and maybe you get this little volume spike, maybe that'd be a good buy. Okay, so that's kind of little how to use this. And like I said, volume is all right, but it's nothing compared to what I'm going to teach you later in this course. It's good to be aware of what volume is, and that's really all I want to say. So just know it's the number of transactions, and typically when we get good volume or really high candles or high volume, it means there's probably going to be good price action. That's why you always see, like, during lunchtime right here, see how low the volume gets during these times, right? Look how low the volume is during these times. And even like here is kind of low, but look how much lower the volume is during lunch than versus like the morning session. It's because A lot more people are going to trade the morning than lunchtime. And that's why, that's one of the ways ICT gets his kill zones. And I'll go over kill zones in another video, but it's because there's more volume here and more volatility equals better price action. Okay, so just know that more volatility equals better price action. And you don't need volume to see good candles and good price action. I already know from this candle that this is going to be good volume, and that's just because I've been in the games for so long. And look at this candle, like compared to these candles. Where do you think the volume is going to be? In these choppy candles or in this giant up big momentum candle? Probably this candle. So it's just good to understand. I think the main thing you should get out of this video is the more volume, the more volatility, which equals a better price action. And if you kind of have that concept in your head, you're going to understand where kill zones come from and later in the boot camp. And I think that's where your connections in your brain should be made. So, and that's why people say don't trade Asia session either, because Asia has like no volume. Okay. My buddy always says someone in Pakistan could be selling their camel and the market could dump 200 points, and you don't want to trade Asia during that because anything could happen. But in reality, there's like barely any contracts getting traded. So theoretically, if I entered 10 contracts during Asia, I could move the market by myself. So that's kind of what volume is. Good volume equals good volatility, which equals good price action. That's the connection you want to make. And that's it for this video. Peace.